Very busy week in equities this week with a bit of a surprise ending. And as we saw equities come down, the E-minis down 11% this week. The selling continues. The treasury yields going down. We saw gold prices get hit. Oil prices got hit. It just seemed like just a crazy week. One that showed a lot of disconnection between the asset classes. Volatility came back to the market, and it was one of those weeks where you felt like it might be over, but then you come in the next day and it's not. We saw that drop continue today. And then at the end of the day, when we're all writing our write-ups and you're saying down 2 to 3% in the E-minis and down 11% for the week, we get a pop of about 100 handles. So 28.80 was the trade late in the afternoon, going into the cash close, and pop, everything goes higher on some late day buying. There may have been some news. The Fed chairman had written a letter talking about the Fed stands ready. That wasn't the reason why equities popped, but certainly helped. And I think at this point, the market just seems very confused, as do central bankers, as do anyone trying to find a cure for this coronavirus. There's just a lot of confusion out there, and that has created fear. Fear is something we haven't seen in the markets, probably going back to 2009 when we had that Lehman moment, when things were, what are we going to do now? When nobody stepped in and things got worse before they got better. And if you look at what we had this month in February, we traded as high as close, above 3,300 in the E-minis, and then today we got down close to 28.20, 28.30, 28.25. So it was a big reversal from the February highs, all time by the way, down to February lows, which we hit today, but we did see a big bounce. So it'll be interesting to see what happens Monday. A lot of weekend headline risk, and I don't think this problem goes away just because the central bankers stand prepared to step in. I'm not sure a central banker cutting rates can help cure a disease at this point. I might be a bit cynical. But market volatility. Yeah, the VIX index came back in waves. So we saw the VIX index get as high as it has in 2 years, close to 50. It's going to close the week out with a 40 handle, something nobody really expected, I think, coming into this week. But certainly the spike has jarred memories of when we were talking about growth risk and fear of the global growth slowing down way back when in early 2018, and before that, you had Brexit risk, you had presidential election risk in the 2016. Going back before that, you had the taper tantrum and tapering. How's that going to affect the market? So you have a lot of these events over time, and this happens to be one of them. The coronavirus is here, and it's really affecting global markets across the board. So volatility is through the roof. It is something we have not seen in a long time for a sustained period. This is going to be something we're going to have to adjust to. As not only to the downside either. Volatility has been very directional in stocks. Obviously, when we go down, volatility goes up, and when we rally, everybody relaxes a bit. But as we saw today, we will see price action moving in both directions, and it could be painful in both directions for the fast money that comes in and out of the market. Long-term investors will sit back and watch and hopefully not get too concerned with the day-to-day trades, but as we saw late this afternoon, big moves can come in either direction. Don't bet on just one way. And the market moving south all week and then getting a closing rally, I think certainly affected some P&Ls as we go into the weekend. I think what can we look for ahead? It's very clear here that price fluctuation, volatility, and now we're hearing about possible rate cuts from the Federal Reserve. Yeah, the Fed funds, they've been pricing in a rate cut for the August meeting. Some are calling for a 50 basis point cut at the March meeting, and some are calling for a 50 basis point cut at the March meeting. Year-end expectations priced via Fed fund futures are looking at about 100 basis points of cuts. So with the Fed effective at about 158, that takes us down to close to 0.5%. That's kind of where we were in the zero interest rate environment, the ZIRP as we called it, zero interest rate policy back after 2008 and 2009. So right now, I think the markets need to take a step back. Calmer heads should prevail, but look for risk assets to continue to suffer as the coronavirus continues to spread and continues to create more uncertainty in the world. And rates right now, 10-year note yields trading about 50 basis points lower than they were auctioned off earlier this month in the 10-year note. That certainly has to be of concern. So right now, the market is very disconnected. Maybe next week we get some of that connection back. Obviously, the Federal Reserve meeting later in March, that could be an opportunity for them to give some clarity, but it seems that they want to get out in front of this, so they issued a letter today, and we'll probably continue to talk about what they can do or might do, not what they will do, because that won't come until the March FOMC. But at this point, they stand ready to act, which suggests that there may be a rate cut coming sooner than later. and many expected that rate cut today. It didn't come, but obviously with all that's happening in the markets, lower stocks look to be on the horizon. But again, fast money, look out, because we did see a big rally at the end of Friday heading into the weekend, and that could be more of that for next week as we look ahead, and hopefully we'll get some clarity on what's happening with the coronavirus. But don't expect a cure, don't expect anything to change here overnight. This is going to take time.